I mean, if you look at, one model that everybody pretty much unanimously agrees on, it's the modern portfolio theory. And, that model and the math behind that model is driving the risk parity strategies. And certainly to my knowledge, again, I don't know specifically, some of the biggest hedge funds in the world use risk parity. They don't disclose the exact models. That's an unknown. But I'll tell you, it's a fact that some of the biggest hedge funds in the world lost a lot of money during COVID-19 when liquidity dried up. So either they got it wrong, or they didn't account for it. And I think it's a reasonable people could probably surmise that's not something that they really focused on. I think risk parity is a really interesting topic. And I know some reporters, some journalists have covered this because some very, very well-known names, have staked their reputations in the strategy.
Cliff has this. Sorry, go ahead.
Yeah, but I don't think that enough has been written about this. Risk parity is something that at this point has even crept into retail investing. There are literally robo-advisors that are advertising this as a way to effectively diversify and reduce risk. So this is a big deal.
Yeah, let's talk about risk parity. So we should probably start with, to the extent that we can, defining it. Now, correct me if I'm wrong, and here's my understanding of it on a very base level. It's basically this idea that you will, as a portfolio manager, move assets. Okay, basically you have a group of assets, call it, something that's risk-free, call it treasury bonds, right? Something that's high risk, tech stocks, and then a couple things that are in between, large caps or whatever. And my understanding is that when one of these are out of favor, the portfolio manager will go overweight into that asset class and underweight the others. So, for example, in March, when, again, it was all risk off, everything was risk off, and everybody was chasing treasuries, piling into treasuries, what the risk parity model would do would go into something a little more high risk, call it tech stocks, and underweight the treasury element. Is that basically right?
I think that's probably how it's implemented today in 2020 in a lot of funds. Again, I would just reiterate that every fund, has their own flavor of this.
Yeah.
But I think that's generally right. If we just go back to the beginning of it, the basics of risk parity are even simpler than what you've just described. I think what you've described is an optimization of the risk parity strategy. But some very smart people, some very well-known people at a very well-known hedge fund actually initially popularized the risk parity strategy originally. They market this as an all-weather strategy, all-weather portfolio. And what they did originally is they took what was in vogue at the time. This was decades ago, and they tried to improve upon it. And so traditionally in the investment management industry, the baseline was a traditional 60-40 portfolio, 60% stocks, 40% bonds. Earlier, I mentioned the modern portfolio theory. They used a lot of the math and the assumptions and the implications of that theory and applied it to its logical conclusion. So the 60-40 portfolio, the traditional portfolio, has some really interesting characteristics. Although it's weighted nominally 60% stocks, 40% bonds, I think most people would agree that generally speaking, stocks are high risk, high reward, bonds are low risk, lower reward. And I think most people would agree, and I think there are, again, economists who have won Nobel Prizes on this, but I think most people would also agree, as the Nobel Prize-winning economists have posited, that most people are risk averse, that if you've got two securities and one's riskier, then you're going to have to compensate them more, give them more reward for them to invest in that security. So those are two, seemingly pretty logical assumptions that we can make. What's really interesting is that the modern portfolio theory and the proponents of risk parity strategy, and very importantly, they define risk as volatility. So volatility being, the up and down in my example, of stocks, the up and down movements of bonds. And the idea is that when you combine stocks with bonds, because you're using volatility as your measure of risk, you can actually do something kind of interesting. You can combine stocks, which have one kind of risk profile, with bonds that are mathematically relatively uncorrelated, another math concept. You put them together, and kind of like offsetting sound waves, they reduce the overall volatility of the portfolio together. So in essence, the theory here is that you put them together and you're reducing risk, and yet over the long term, stocks and bonds, you're still going to get the long-term returns of those stocks and bonds. So you reduce risk while preserving your long-term returns. You essentially have given yourself a free lunch. And literally, when you look at the literature, that's what proponents of the modern portfolio theory and risk parity believe that they've done, that this is a free lunch. Sounds suspiciously to me like what the subprime mortgage crisis, when investment bankers bundled a lot of crap together and then labeled them as AAA securities. But that's probably a topic for another day.
Yeah, but this all gets to you mentioned a free lunch, and this all gets to one of the major problems that I've always had with a lot of the hedge fund strategies, which is that I don't quite get how you can get reward without risk. And anybody who says otherwise, it sounds a little like snake oil. Like, how do you strip the risk out of the potential reward, unless you have inside information, right?
Right.
But so it's just kind of like, it's a bit of a fallacy, isn't it? I mean,
I think that's right. And going back to the story of the development of risk parity, I think that's exactly what is happening. I mean, that